Students, today I am considering part 3 of monetary policy, wherein I'll be talking about the qualitative credit control instruments, or the alternative name for them as selective credit control methods or mechanisms under monetary policy. The first one being credit rationing. Credit rationing, and the alternative name for this is ceiling on credit. As far as the word rationing is concerned, the rationing means apportionment or allocation, apportionment and allocation of credit. So, what all it includes, I'll be talking about it. But regarding this, I'll be first talking about the applicability of this particular concept in Indian economic scenario. It is applicable in case of shortages of institutional credit that is available to the businesses. See what happens in that case. The large and financially strong sectors and industries, they tend to capture the lion's share in the total institutional credit. When a big business house with good huge amount of funds approaches the commercial banks, then even commercial banks are inclined to lend for their funds to such business houses and such big business daddies rather. So in that case, what happens is the priority sectors and essential industries are starved of necessary funds, and because the bank credit goes to these non-priority sectors. So in order to mitigate this practice of lopsided provision of funds to affluent and big business houses, what RBI has done, it has administered two measures. First one being the imposition of upper limit, or upper limit is nothing but the credit ceiling, or it is a ceiling on credit, and it is basically a ceiling on the credit that would be available to those who will be demanding it. The second thing is charging higher rate of interest on the loans above the specific limit. This concept can be explained with the help of an example. Supposingly, a big business house requires a credit amounting to rupees 100 crores, but the ceiling that has been put for provision of credit is 80 crores. So in that case, there is a ceiling on the limit, that is there is a ceiling on the credit limit available. So the ceiling is on the 80 lakhs. They cannot avail credit more than 80 lakhs, but in case they want to do so, they can do it, but they need to pay higher rate of interest on loans above the specified limit. Means above, if in case they want to avail more loan amounting to 20 lakhs, that additional amount of loan would be having with it the additional amount of interest. The next is the change in lending margins or margin requirement. Before understanding this concept, just imagine a case. Supposingly you have a property in your hand. It may be a land, a building, or a jewelry, or anything else you have in your hand. You approach a bank and you require credit. Then do you think that on the value of mortgaged property, the bank would be giving you an amount equivalent to the value of mortgaged property? And the answer is no. Supposingly the value of mortgage property is 100 crores, and if you think that you'll be getting a loan amounting to rupees 100 crores, I really appreciate that thinking, because it will not be leading to results. Because here what happens is, the loans are sanctioned against the security. The security means the mortgage property is nothing but it is the collateral security. The loan would be sanctioned against it, but the bank would be keeping a specified percentage of the mortgaged property. It will be keeping a percentage. It may vary from 20% till 80%, but there has a specific provision of percentage. Then the gap between the value of mortgage property and the loan advanced at lending margin. This is something theoretical. Let us understand this concept with the help of two situations. In these two situations, we will be understanding the concept of lending margins, as well as we will be understanding the concept which says that higher the lending margin, lesser would be the loan sanction. In situation 1 and situation 2, the value of mortgage property is 10 crores. The value of mortgage property has been kept equivalent for comparative analysis purposes. Now in first situation, the lending margin is 40%. 40% of 10 crores gives you 4 crores. So the amount lent after deduction of 4 crores is 6 crores in first case. And the value of mortgage property in the second case is 10 crores, as in the case of situation 1. The lending margin here is 50%, means 50% of 10 crores gives you 5 crores. So the amount lent is 5 crores by the commercial banks to the general public. It can be easily noticed here that when the lending margin has been enhanced from 40% till 50%, the amount which was lent was initially in situation 1, it was 6 crores. Now the quantum of the amount got reduced from 6 crores to 5 crores in the second situation. So it justifies the concept that higher would be the lending margin, means from 40% till 50%. The lower and lesser would be the loan sanction, that is from 6 crores to 5 crores. Moral suasion. Suasion is nothing but persuasion or convincing. Who is convincing here whom? The convincing power is in the hands of the RBI, and the commercial banks are being convinced. Why they are being convinced? They are being convinced because they are being directed to work in overall interest of the country. Here in this method, what RBI does, it basically persuades and convinces the commercial banks to advance the credit in accordance with the directives of RBI. So and this is a method which can be adopted in addition to quantitative and qualitative other methods of monetary policy. They may be qualitative, they may be quantitative, and this method is particularly useful wherein the other methods of monetary policy have either failed or they have proved to be doubtful. So what is done under model suasion? RBI issues periodical letters to banks to control credit in the economy, and periodical discussions even they are held with the authorities of commercial banks in this regard. But this is a moral suasion is a humble policy that is opted by RBI to ensure that everything in the economy is done according to the directives of RBI, and it should ensure the overall interest of the economy as a whole. The last and most harsh measure that is adopted in case of monetary policy is the direct control. It is used where all the other methods have proved to be ineffective, and RBI does not have anything in its hand now. What it does now, it resorts to direct control measures with clear directives to carry out the lending activity in a specified manner. It gives clear instructions to the commercial banks that yes, whatever they need to do, they need to do in accordance with the directives and instructions of the RBI. They cannot evade those instructions. So however, as far as the application of this policy measure is concerned, it is used in rarest of the rare case, because even RBI is reluctant to opt such a measure which is quite harsh in its approach. So these are the four qualitative instruments or the selective credit control mechanisms which are used under monetary policy, and these being credit rationing on one end, on the other end there is a change in lending margins, moral suasion, and the last one being the direct control. So I hope monetary policy would be clear uh, uh, with the help of part 1, 2 and 3 of the study material or the presentations that are being circulated.